All right, hey everybody, it is Bob Icino. You know me from the Pure Exposure Growth Series, and I'm starting a new thing here called Pro versus Pro. Now, before I get started and introduce the two guests that you can see on the screen already, Pro versus Pro is not about conflict. It's about intelligent conversation of two people who might disagree with the overall view of a particular asset class or segment of the market. But remember, they can both be right because a lot of times these things are about duration. So I just wanted to get some intelligent views on the NASDAQ right now. So with me is Jimmy Iuorio, who you know from our show, Managing Director at TJM Institutional Partners, good friend of mine, and also Todd Kobayashi, who's a partner in Enerstrat, which is a real estate consulting firm. Todd was also the first person to ever teach me about technical analysis back in the days when I was at Nico Securities, and he was there as well. So when I tell people about one of my early mentors, Todd Kobayashi, they tend to think of like a guy from The Usual Suspects, like shadowy and like you wear a hood and stuff. But,
yeah, I get that a lot, I'm afraid.
Yeah, I assure you, he is just a normal guy, although he's way too obsessed with golf. So we're talking about the NASDAQ here. And Jimmy, if I could, I want to start with you because I don't want to go over on time. The NASDAQ is about, save for today's sell-off, and it is, let's bookmark this, it's about 1:05 Central Time on May 12th. And we're getting a tiny bit of a pullback in the NASDAQ. The NASDAQ, though, as of this morning, was about 4.5%, 5% away from the all-time highs. So, Jimmy, you've got a slightly bullish view, and let me give you your sort of 3 minutes to explain that.
Okay, it's definitely, when you look at the medium and long term, I think it's more than just slightly bullish. But let's look at what this major conflict is before we kind of hone it down to the NASDAQ itself. It's, on one hand, the antagonist is definitely this massive cataclysmic economic event we've had happen, and we all agree on that. And the other side, and this has been from the beginning too, is we had a Fed and a federal government who we knew from the beginning was going to throw every bit of ammunition they had at this. And to underscore that point, I'll look back to the March 23 lows, which was absolutely when we were pricing in Armageddon. And what also coincided with that day, that was the day the Fed came out and announced unlimited QE. Okay, so now we have the Fed that's just said, we're not going to let this happen as far as asset prices declining. Federal government, we know just today now they're talking about another $3 trillion stimulus. I like to repeat that number twice because of the unbelievable size of it, a $3 trillion stimulus, and they throw it around like it's nothing. Okay, so now you look at the fact that the NASDAQ is leading. And if you break that down, that seems like an obvious reason why. I mean, energy's up there too, but energy from the bottom just because it was the most beaten down. But right. Technology within this potentially newer world of staying at home, telecommuting, things, technology obviously is something that's going to facilitate that a lot better. And some of the usual suspects have gotten their tremendous bid. Google, Amazon, Apple, it's obvious. Netflix as well too. I don't have to, underscore that for why that's good too. Now there's another element of this that I believe is important in that we talk about our central bank and government throwing money at it. The world's central banks are also throwing money out into the system to try to stop this problem. And I think to believe that some of that money is going to end up in the U.S. is completely reasonable. Now, we're at a spot here on Tuesday, May, whatever you said the date before that it is that we are looking so intently at seeing some good news come out of Georgia, Texas, or Tennessee, some of the states that have opened yet. And we are seeing some glimmers of hope. My belief is that, and my belief has always been this, that for this next move that's going to go above 2950 or 2960, I think we need to see those glimmers of hope, and that might take a week or two. And in that time, I think we could trade sideways to a little bit weaker. But at the end of the day, my full belief is that when the threat from the virus begins to wane, what we'll be left with is central bank money, not just U.S. central bank, global central bank money sloshing around this globe. And we know this. People, I was talking to some smart people today, they were like, well, if a vaccine comes out today, the central bank will pull back so quickly. No, they won't. Central bank tends to stay around longer than they should and inflate asset prices. So I think come June, middle of June, end of June, middle of July, I think you're going to be in a situation where asset prices are going to do quite well.
So Todd, pretty compelling medium-term case. Let's talk a little bit about your view, which is slightly more bearish than Jimmy's, and kind of take some of Jimmy's points and see how they play into your view.
Yeah, I mean, I think a lot of the NASDAQ piece of this is important. I mean, this has been a real kind of haves and have-nots in this marketplace, and obviously a lot of the haves in this world, you know, some of the Amazons, the Facebooks, the Googles who do well even in this environment, their stocks have obviously done well. But what that's done too is it's created a very narrow market. You know, we've got about 20% of the S&P 500 is now represented by 5 stocks. I mean, historically, that's even higher than what we saw in 2000, 2001. It's really the highest we've seen since the early 80s. So it's a very, very concentrated market. And that's not usually a healthy market. You know, usually markets like that, you know, tend to come back to reality. And my message is really one more on kind of economic gravity. You know, when you look at what's gone on in the economy, you know, and I kind of wrote down some of these industries, you know, whether it's oil, travel, leisure, exporters, entertainment, airlines, car companies, car rental. I mean, these are all places in the economy that have been injured, and that while they'll come back some, they're not going to come back to the levels that we saw in 2018 and 2019. And I think there's been enough injury done in the economy to make that a very difficult proposition that we should be back at prices that we've seen, you know, just back in 2019 when things were a lot better. And you look at a chart of S&P earnings versus the S&P 500 index itself, and those have been just a huge divergence, you know, between where earnings are and yet where stock prices are. Now, obviously, that can go on for a little while, but ultimately, you know, gravity tends to pull back down toward where earnings are. So at the end of the day, it's kind of an estimate of, you know, where do you think market earnings are going to be in the next year or so? Are they going to be back at levels we were in 19, or are they going to be some large shade less than that? And I think my case is it's going to be a large shade less than that. And, you know, there's some technical reasons also why the market, I think, has rallied. You know, we've had a fairly large short position in the S&P 500 that, you know, we even have in the market today. So, you know, some of working through that short position, I think has caused the market to come up because there's been kind of a large buying interest that's behind the market. I also point to some backdrops that just, these aren't necessarily trigger points, but they kind of give context to what's going on. You know, right now, the U.S.'s market is really kind of tracking M2 pretty closely. Whereas M2 grows, you know, so does the S&P 500. We had a similar market to that in 82 to 89 in Japan. And this is one of the things that Charles Gave kind of put out in a piece this week, where he pointed to that section and said, look, when did that end? It ended when profits basically fell off the map in Japan in 89. And that's when that tie between M2, which is really kind of what the Fed is doing, and economic gravity, which is, you know, what earnings are doing, that's when that fell off the map in Japan. And I think we're going to see something similar here.
Interesting to me, I don't honestly hear a ton of disagreement in the macro. It really does seem like this is more about the duration in terms of Todd, I think you're saying that Main Street is going to pull the stock market down. Is that a fair oversimplification?
Yes,
Jimmy,
I think Main Street.
Go ahead.
Yeah, Main Street and just corporate earnings themselves as they come in. I think a lot of corporate earnings right now are being ignored because people know it's bad, and without guidance and things, they don't necessarily know how bad it is. And yet some of the others, they are putting projections on some of the winners, which are a little bit easier to project right now.
And Jimmy, I think to oversimplify what you said, you're saying we're trading liquidity, and liquidity is going to go on a lot longer than many people think.
Right, but to Todd's point too, there's an expiration date on when the market will forgive. Excuse me, I swallowed something wrong. When the market will forgive bad earnings for how long? So if there's 1 quarter, 2 quarters of terrible earnings, I think the market could forgive that. If it goes on beyond that, you know, I definitely think this could become problematic. But my base case scenario is that the Fed stays too long at the party and inflates risk assets, as they've done before. And that might end in tears at some future date. But right now, I think come mid-June, I'm going to be very bullish.
Again, guys, you've got the view of 2 actual professionals, pro versus pro. Some agreement, some disagreement, might be on time frame, but I appreciate you guys watching. Todd, Jimmy, thanks for being here. If I find another spot where you guys slightly disagree, we'll do this again.
Thanks, Bob.
Cheers, guys.